look at page 38. Okay. Now the answers to this question officially, when it was released, there was a small overlook. So after that, the examiner amended their answer. So after amending their answer, there's some very strange thing. You look at the answer. So students always look at this and then they always say don't understand, don't know why like that. Okay. So that's why I think it's nice that we just do. So I explain to you. Okay. Because it was a very slight overlook, but has a very material impact. So that's why when the question was set, examiner didn't realize. It was only realized after, when the thing was published out to the lecturers and markers to go through. Okay. Now, so what they want us to do here is to say, prepare a letter from FISTI Tax Services to the trustee, giving the advice that trustee have requested on the following matters. Okay, number one, whether the trust is resident or not resident for 07 and 08. Number two, whether the trustee are liable to Malaysian tax for 07, 08, giving an explanation. Okay. Assuming that the trusts are liable to tax for 07 and 08, and the amount that would be payable for each year. Okay. Without regard to the installment payment that trustees might have to make. So what is the amount that would be payable? Now, whether Vasala is liable to Malaysian tax for 07 and 08, with a brief explanation. Whether Chandran and Shanti are liable to Malaysian tax for their share of the trust income for 07 and 08 as well. That will again present in a letter. Okay, right, so there's quite a number of requirements here. Okay, let's see what they want. Okay, Subramaniam passed away suddenly in 2006, leaving his sole trader business to be carried on by his executor. Now, by 1st January 07, the administration of the estate had been completed and the trust period began. The executors, his brother Bala Singham, and the son will continue as a trustee. So the trust asset consisted of the business formerly carried on by Subra, some shares in the Malaysian company, and some shares in Indian company. However, the business of the trust was transferred into a company called Chandranti Sdn Bhd on 1st July 07. The trustee continued to hold all the shares in the company. So they now have the business transferred into the company. So now the trust will only hold share. Okay. Now by his will, Subra provided for his asset to be held on trust for beneficiaries as follows. Okay, there's annuity of 2,000 per month payable to the wife called Vasala. Now half of the income remaining after charging annuity will be to his son Chandran, who is now 24-year-old. So half of the income after annuity. Now half share of the income remaining after charging annuity to the daughter Shanti. However, the income will be accumulated until her 18th birthday, which is on 1st October 2008, when she became entitled to receive it outright. From that time, she is entitled to receive half of the income arises. Now all beneficiaries were resident throughout except for Chandran, who became resident in India with effect from 1st January 2008. Now Bala Singham has been resident in India throughout. Now these two persons very important, right? Because Bala is the trustee, Chandran is also the trustee. Okay, so it affects resident status of the trust. Now the relevant information for the tax. So they gave us the income for 07. Business is loss making. There's a balancing charge, the CA. Then dividend wise, Malaysian dividend. So after tax is 27. Now this is the old rate, okay, 27. Now the Chandranti pay single tier 60. The Indian companies after 15% tax is 27. Now the interest received from Malaysian company is 40. Approved donation of sports equipment. Now you can see in 07 they remitted foreign income. Okay, there's still foreign income. Now in 08 you can see purely Malaysian income. There's no more foreign income because it's only Chandranti and interest. That's all. Okay. Now so this affect the status of the annuity. So that's why it's important to analyze all that. Now, so first of all, now again, I leave the letter format for you, okay? So please remember, who are you? You are 50 tax services and you're writing to the trustee, okay? So make sure that you address to the right people. That means you address to Bala, you address to Chandran, okay? So these are the people that you write to. Now, so a few issues. Okay, number 1A. Now, whether the trust is resident or not, all right? Now, whether the trust is resident, so what's the rule or what's the law that they say? That they say as long as any one of the trustee is resident, the trust is a resident trust, okay? Now, if you want a trust to be a non-resident trust, there are two ways. One is all trustee must be non-resident. The other one is they say at least half, but that one got a lot of condition, because you know that the trust must be set up outside, administered outside, the income from outside. So all these are the condition. But here is more straightforward. Okay, number 1A. Now a trust is a resident if at least one trustee is resident in Malaysia. So for YA07, it is a resident trust because Chandran is a tax resident. Okay, a trust is non-resident if all the trustee are not resident in Malaysia. Now the other one I don't have to explain, so it's just 3 marks, so this will do. Now so in that case you can see for Y2008 that both Chandran and Bala are not resident in Malaysia, so the trust is a non-resident trust. Now, B. So whether the trusts are liable to Malaysian tax. Now whether you're liable to Malaysian tax, the important thing is what? The derivation only, fair enough? So the law is very simple. Income that's Malaysia derived, resident or not, you still pay tax, okay? And the resident status does not affect the taxability. It only affects the way how the tax is being computed. Okay, so, so in this case, the resident status of the trust does not affect the taxability of the trust income. So what is affecting is the derivation. Okay, so the taxability is affected by the derivation scope. So if we say affected by the derivation scope, then basically it's very simple. As long as income is Malaysia derived, is subject to tax. Okay, so any income that is deemed derived from Malaysia would be liable to Malaysian tax. But for 07, okay, for 07, the difference is 07, the trust has remitted foreign income into Malaysia. Okay, because if you look at the statement, you can see there's this 27,000 that they remit. Now, so if you remit foreign income into Malaysia, then such income is tax exempt because it is a resident. Now, that's the main issue. So derivation. So the trust, whether liable or not, depends on derivation. Okay, now see, they say, assuming that the trust is liable, how much will the tax be? That means they want you to work out the tax. So what they want you to do now in C is to work out the tax. Alright, so part C, you have to explain the amount of the tax. Now, of course, to explain the amount of the tax, you do it in appendix. Okay, so you just refer to appendix, and you will say that the amount. Okay, so I'll put down the appendix. Okay. Now, so the income that we see right now, it's the issues that we got to work out the tax com. Okay. Now in 07, we notice that the business is still there. Okay, so there's the business loss, CA, BA, BC, sorry. Okay. Okay, now they receive dividend. Alright, they receive dividend. Now this dividend, I just change the rate so that you don't feel strange. Okay. Now can I just put net at 25? Okay, you just change this to 25 and put this at 7.5. Because last time the corporate rate is still 27, so there's no issue. Just change this to 25, so 7.5. So the gross amount is still the same. Okay. All right. Now, so you get dividend. This dividend is taxable. It's a frank dividend, so you're gonna pay tax. Okay. Now then, this foreign dividend doesn't affect you. All right. Now this is 07. Okay, so you work out the tax for 07. Okay, why 2007? We start with business. Okay, start with business. Now the business has no adjusted income because you made a current year business loss 20,000. So zero adjusted income. Okay, now we see that in the business there is a balancing charge and there is a CA. Now of course the charge you must add it in, right? So the BC 75, and the CA is 50. That gives us a net charge 25. Now this sort of thing is very fundamental. You must remember, charge must come first. Okay, charge must come first. So like here, Richard is not killing the student. He arranged the charge first, then the CA. So if the student just follow the sequence, no problem. If the student pandai go and change, CA first, then charge, sorry, you lose one part of the mark. Okay, so remember, charge first, then CA. That's how you arrange. Okay, now so after the 25,000, the SI is 25. Now, so once you finish 4A, then we move on to the investment income, which is 4C. This is a trust, it's not a company. If it's a company, then the dividend you put at the bottom. So if it's not a company, the dividend stay on top. So that's why you're going to have your dividend, which is 7,005 divide 0.75. So 10,000 ringgit. That's it. So aggregate is 35,000. Alright. Now minus current year business loss 20. And you minus annuity payable. Okay. Now, the annuity payable is 2,000 per month times 12 months, so it's 24. But you look at the income you have, you don't have 24, so you restrict to the most is 15. So now the trust has no total income already. Okay. Now the total income of trust is very important to determine how much beneficiary is assessed to tax. So the total chargeable income is nil. So your tax payable is nil. Okay, but then you minus off your credit, right? Because of the dividend, 25% times 10,000, so 2,005. So there is a tax repayable 2005. Okay. Okay. So this is the amount for 07. Alright, this is the amount of 07. So now we're going to see the issue for 08. Now the problem with 08, now again, it was not intended, alright, it was an overlook. Okay, so it was an overlook, but still examiner has corrected the answer. So what happened is, I must tell you why it's like that. Now, the examiner say that work out the tax, how much tax that you got to pay, okay? So you got to work out the tax, right? But you think and see, the issue now in 08 is 08, you're a non-resident, okay? You're a non-resident, and you look at the income that you're receiving here. Now, there's only two income: dividend. Dividend is single tier, which is tax exempt already. So you're not going to get a tax on this dividend. So the 60,000 effect disappeared. So now you receive the other income. What income is that? Interest. Now, so the part that we overlook is when you receive interest, and because you're a non-resident, you will get withholding tax. Is withholding tax, correct? Because there's no other things, or you don't even have a business already. It's all investment only, okay? Unless you have a business, then different story. Then at least you still got a PE. So now you just have investment, so you're gonna get interest. So the interest will get withholding tax, and withholding tax is final. So it's taxed on gross already. So there's nothing else that you're going to pay. So that's why for 08, the withholding tax suffered already. Then immediately what happened is you have no tax liability to pay because you suffered the final withholding tax. But how much tax you suffer, you got to show what. So that's why examiner did this in his answer. Okay, so he showed that for Y08, okay, now the tax on the interest income is 15% of the 40,000, right? Okay, this is a withholding tax, which is tax at source, where such tax is final to the non-resident trust. Now, I explain to you the answer because every time student will ask why like that. Okay. Okay. If you do a bit of imagination, then you understand it. You notice there's one column here, right? Now, actually, there was a column here, because 07 and 08. Then he realized that the withholding tax issue, so you shouldn't have a tax comment. So what he did was he asked UK deleted. I presume that what he must have done. He asked UK to delete this column. That's why you see suddenly one column like something disappear, right? Something disappear, or else the margin doesn't fit. You think and see why the figure like that, like the margin like not, because there was one column here. So examiner must have asked them to delete this part. Okay, deleted. Now then when they delete, they only delete the column. Now you notice why got donation? See, got donation, because originally there was an answer for 08 that he wanted to test the student the claim of donation, whether you remember the rule or not. But unfortunately, because he overlooked, so this one cannot test already, because the figure is in 08. So he deleted the column, but I think they never delete this one. So that's why you see the answer, how come got this thing suddenly appear? So I just want to tell you why like that. Now then what he did for 08 was like this. He said that the interest is 40. Now you don't see any tax com, right? He just said interest is 40. Then he said tax is 6,000, credit is 6,000. Why 6,000, 6,000? You'll be thinking, what is this? Now actually, it's withholding tax. So he's just trying to tell you that you suffer a 6,000 tax. But the 6,000 tax is deducted by the payer. So that's why you don't need to pay one. So the 6,000 tax minus the 6,000 that the payer deducted. So actually it's withholding tax. So actually you don't show like that also, never mind. But because he show like that, it become even more confusing. You know? So that is exactly what he's trying to say here. That for 2008, you just suffer withholding tax 6,000. Okay? Now that was how the figure was derived. Just explain to you. Okay? So this is the issue here that we see for part C. Alright, so that's the tax that he must pay. Okay, now move on. Okay. So you must explain, explain your computation. Okay. Why that 07 you have tax and why 08 you only pay 6,000. Okay. Alright, you explain that. Okay. D. Now D, they ask that whether Vatsala is liable. Now, what is the income that Vasala is receiving? Receive, don't say receive, entitled to, she's entitled to the annuity. Okay, she's entitled to the annuity. Now the question is, how much is the annuity income that she's entitled to? Now usually the annuity income is based on the payable, right? Now if the trust is resident, we follow the payable. We don't look at the amount you deduct one, because just follow payable. Now amount payable is 24. Okay, amount payable is 24. Amount deducted is only 15, but it's still based on payable, which is 24. Now then in 2008, the trust is a non-resident. Now usually as a non-resident trust, it might affect the income from annuity. But then there's another part of the law, if you read back the notes, I can explain to you. There's another part of the law that say, if the income of the trust is wholly derived from Malaysia, 100% Malaysia derived, then the payable is still annuity income that is accessible to the annuitant. So in that case, even though you realize that there's no deduction, but it doesn't matter. Okay, so this is the issue that we see here for Vasala. Now, so first, for Y07, you have to explain that the annuity payable 24,000 is a source of income accessible to Malaysian tax. Okay, because the trust is a resident trust for 07. Now the reason is this: resident. Once you're resident, you follow annuity payable. Okay, for YA08, now even now the trust is a non-resident, the annuity payable of 24K is still a source of income accessible on Vasala, because the whole of the income of the trust is derived from Malaysia. So the condition is this. We are testing whether you remember the second part of the law. Okay. Alright, so this is the part to do with Vasala. Okay, what happened now to the beneficiary? Now that's the last part, the E. Okay, they say whether Chandran and Shanti are liable to income tax or not. Now, if you look at 07, we look at Chandran first, okay? Now, what trust is this? It's non-discretionary. It's fixed already, right, the ratio, correct or not? Half goes to you, half goes to her, okay? And Chandran has no accumulation. Accumulation is with the daughter, correct or not? So Chandran is NDT, he's entitled to the income. Now for NDT, how do you assess the tax? You assess tax by taking total income times percentage. There's a formula, right, correct or not? So you just take total income times percentage. So what's the total income in 07? There's no total income, right? So you notice in 07, there is no total income for the trust. So Chandran's share of the total income will be nil. So in that case, he will not be subject to tax on the trust income because the trust got no income. Okay. Now Y08. Again, the trust is a non-resident trust and subject to withholding tax, which is final tax. So again, there is no total income for 08. Okay, or different way of looking at it is you can say that the amount is 40,000, the tax is 6,000, okay, the 15%, okay, 6,000, and then later you give half to Chandran, then Chandran will also be liable to the tax and then get a credit. But actually there's no such thing because once it's withholding tax, finish already. So easier to just say that there's withholding tax is final. So that's why the trust is not paying anything. So the trust got no income. So the gain, Chandran is not liable. Okay, now that's for Y08. Okay, look at Shanti. Okay, now the issue now with Shanti will be accumulation. Alright, now first of all, Y07. Now she only turned 18, right? Yeah, she turned 18 on 1st October 2008. Alright, so the issue for those before 18, now of course there's no total income, but the examiner is looking at whether you know the issue about accumulation. Okay, now so in 07, a portion of income from trust is accumulated. So she will not subject to tax on the accumulated income. Okay, now that's how you deal with accumulation, no tax. Okay, in Y08, she received her shares of the accumulated income when she turned 18. There are two things she's going to get. Okay, she received a share of the income when she turned 18. Okay, so what happened now is that share of income is considered as a capital gain and will not subject to tax. Now the difference will come in for her portion. Okay, now she's then entitled to half of the 40,000 interest from 1st of what's the date? October 08. i.e. 5,000. Okay. Now Shanti is a resident. Okay. Just now that Chandra is a non-resident, there's no issue. Alright. So she is a resident. So the trust now will pass the income to her. So she'll be taxed a little. So she'll be assessed to tax as a resident individual. Now, but if she's assessed to tax on that 5,000 because of the interest from the trust, the question now is, then how much is the credit? Okay, the credit will be the withholding tax. Okay, so the 5,000 times 15%, and she'll be entitled to a credit of 750, which is based on 15% of the 5,000. All right. Now it's a bit like that lah. It's a bit odd and a bit strange. You see in this question, it's just because it was not intended to be like that. All right. But after that, they overlook. Yeah, you're non-resident, so the issue will become different. So that's why the change coming. Okay. So I hope that this clarify you the answer. So next time you revise the time. Oh, okay, I know what is this. Okay. Right. So that's the part on trust. Okay. Turn to a few page to 48. Okay. All right. Now the requirement starts in page 49. Now so far, Richard asked leasing a few times in his tenure as an examiner, but I think Ms. Yong has not. So I believe eventually question needs to come out. Okay. So leasing is quite long already. You see December 09 until now. Okay. Now, so we are asked to prepare a letter. So again, your moonwalk, okay, that you give it to Asteroid, providing them the information required by the company. Now the letter should deal separately with the following. Number one, for each of the finance lease, number 1 to number 4, state and explain how lessor is treated for tax purpose. Okay. Now under the leasing regulation, now only the lessor applies the regulation. The lessee doesn't. Okay. That's why lessee is always a lease. Remember that. Okay. Now commencing from gross. So that's why examiners say commencing from gross. Calculate how much is the gross income for each business, because when we do leasing, we divide business into two: leasing source and non-leasing source. Okay, so that's why they want you to work out for leasing and non-leasing how much is the income. Now then suddenly he said commencing from the profit. So that's how he tried to trick the student. So first he said gross. Now he wants you to start from the profit again. Okay. Now start from the profit. Work out the chargeable income for Asteroid. That you must show the adjusted statutory from each business source and the aggregate. Now your computation should be based on the assumption that nothing is disallowable except for what is obvious from the income statement. And if there's any apportionment between the separate business source, you apportion using gross income. So it's given you the basis. Okay. Now same thing, professional marks is given. Now then B, they ask you explain the rationale of dire leasing. That means why they say the expenses must be apportioned using gross income. Okay, so that one also we explained before. Now we read the case. Okay. Now Asteroid carries on leasing business and makes up the account to 30th September each year. Now for the year end 30th September 09, the draft account shows gross revenue is 1992. Okay, now the expenses include staff, admin, director pay, zakat, depreciation. Now the obvious one is these two lah, correct not? Zakat is donation, you claim as donation, you must have back, claim later. The depreciation also. So these are the two obvious ones. So the profit before tax is 892. Now the company's tax agent, Moonwalk, have been asked to provide an estimate of the tax payable for Y09. So in addition to the draft account, they also given you all this. Now they say the gross revenue 1992 derived from leasing transaction. Okay, they tell you these are leasing made up of income from operating lease. Okay, now we understand if they say it's operating lease, then the term will always be lease. Okay, usually operating lease, it has to be leasing contract. So we don't doubt that. Okay, there's no issue. All right, so normally operating lease is lease contract. Now then they also say that we have income from finance lease. The finance lease is the one that you must be extra careful, right? Because sometimes finance lease, sometimes the terms can be such a way that it become deemed as sale agreement. And if it's deemed as sale agreement, then this is not lease already. It become non-leasing business. Okay, right, so that's what we say here. Okay, the lease of heavy machine granted from 1st January 09 for 72 months, that the rentals is 20,000 per month. The cost of the asset is 980. The lessee may purchase it at the end for 10 ringgit. Now you have an option to buy. Okay, now as long as you have option to buy, then this is sale agreement. Doesn't matter what's the price, as long as there's an option. Agree or not? Okay. Now lease number 2. Lease of a refrigerated road transport vehicle granted on 1st April 09 for 60 months. The rental is 50,000 per month. The asset were purchased from lessee. Okay, you buy from lessee. So it's a sale and lease back. Now lessee own asset for 3 years. Claim CA. That's very important, right? The moment you claim CA, then it's a sale agreement. That's one of the conditions, right? Now the lessee has no right to reacquire the asset, but they can continue to lease at the nominal sum upon expiry. Okay, but no issue. You claim CA, it's a sale agreement. Now lease number 3. There's a lease of IT equipment granted on 1st January 09 for 60 months with the rentals of 45,000. Now the asset were purchased from lessee for 1.8 million. Also sale and lease back. Lessee owned for less than 1 year, and they are not entitled to claim CA. Then there's no issue. You cannot claim. They have no right to buy back. Then also no issue. So in that case, this is a lease, correct or not? This is a lease. Okay. Now lease number 4. There's a lease of office equipment granted on 1st January 07 for 30 months with the rentals of 65,000 a month. The asset cost 1.5 million. Now although the lessee had no legal right to acquire, it was sold to him at a nominal sum. Now, and when the lessee acquired at a price that is not at the market value, then it becomes a sale agreement. So you sell nominal means very cheap. So in that case, this is a sale agreement. Okay. Now, so of all the 4 leases we see here, only this is a lease. These 3 are not lease. but they have included them in the leasing income. That's why you must take it out. Okay. Now the question further said that for operating leases, the amount shown above is full amount of the rental. Okay, it's already the rental, but the rental received. They say rental received. But for finance lease, the amount represent only the interest. That's what they say. Now rentals unpaid are not included in the draft account because they don't recognize them. So these are based on receipt basis. But you know, in tax, business is receivable. So one further adjustment you must do. So they tell you that the income that from operating lease as at 30th September 08, that's the accrued amount. So the accrued amount at the respective date. Okay, the accrued rentals is 140.73. Alright, now so that's it. Okay, the first issue here must clarify is, now they say finance lease is the interest. Okay, finance lease is the interest. Now how much is the interest actually? Okay, you say that 72-month rental. Okay, 72-month rental at 20,000 a month. That means it's 1440. So minus 980. That means interest is 460. 460 divided by 72 months. Then this is the interest per month. Okay, interest per month. Now you start in January 09. Now is September. So there are 9 months. So the interest should be 57.5. Okay. Now but the interest here is 50. So there's a problem. Okay. Now this is not your problem. It's the question got problem. Okay. So the examiner made a mistake also. Alright. So he has made the calculation wrongly. That's why the figure doesn't match. Okay. Now so it's just to let you know that he accepted both answers. That means if a student used 57.5 as interest, he also mark correct. If you have used 50,000 as interest, also mark correct. Can you see not? But the issue now is not which one you mark correct. The issue is you're in the exam, you feel panic. Can you see not? Okay. Now, so I just want to let you all know that this sort of thing is not very common, but it happens. It happens. Okay. So in the exam, if you see that, you just do whatever you can. There's nothing you can do. You just do based on whatever you can. Okay. But please don't always go exam and say figure cannot get. Then you assume question is wrong. Alright, so I scared that everything got mistake. No, okay, very rare. So this is one of those typical cases. Okay, now so the first part is A number 1. Okay, now I already explained to you that lease 1, 2 and 4, they are deemed as sale agreement. Okay. Now, if they are deemed as sale agreement, then the interest income would be income of a non-leasing business source. So you must identify that there is interest, there's non-leasing. Okay. Now, why? Okay, why you read the note okay. So the reason you just refer to the note. Just now I explained to you you revise back those reasons. Okay. Then for lease number 3. Now this is a lease contract. Okay, because to be a sale agreement, okay, to be a sale agreement, lessee must have claim CA, which it did not. The question say never so you must highlight long. And then you need to have an option to buy back, which is all not present. Okay, now of course there are other reasons, but I can't apply that too far. All these what custom made or special purpose asset, all these cannot apply here. Okay, so far there's only two issues examiners say. Now if that's the case, it will be treated as a lease business source at the rental receivable for Y09. Okay, okay, so that's the first part. Okay, number 2. Now they want us to start from the gross. Okay, now the lease rental received in 09. Received. See, you need to adjust back. Okay, you need to adjust back to bring back to receivable. So the received one must have included the accrued amount from last year, and the received must have excluded the accrued amount for this year. So that's why the accrued amount would have taxed last year, right? So that's why I want to minus out the rental for 08, 140. Okay, I take out that one, plus back the accrued rental for 09, 73. So 1925 must be the rental receivable in 09. Okay. Okay. Now lease 1. Now lease 1, it should be taken as leasing. Sorry, it should be taken as non-leasing. Now they already put inside this figure 50,000. Correct? The 1992 is based on the 50, okay? So I will take out the 50,000. Okay, I'll take it out. So I put it back to non-leasing. So I transfer over only. Okay. Now, lease number 2 is the same. Lease number 2, I put 62,000. So I just take out the 62,000 from you. So I transfer over 62,000 to non-leasing. Okay, lease number 3. Now, lease number 3, you have put in 90. But you must put the rental. 90 is what? 90 is the interest. Right now, 90 is the interest. You want the rental. Okay, how much should the rental be? Now, if you minus the, if you take the rental of 45,000, okay, rental of 45,000, you start in January 09, your year end is December, so year end is September, you will take 45 times 9. Now 45 times 9, you're going to get 405. this is the rental you recognize, but you must minus the 90, right? The 90 is already inside already, right? So you minus the 90, then you only add back the different 315, okay? Now, so lease number 3, 45,000 times 9 months minus the 90. So we add back 315,000. Okay. And lease number 4, you recognize 112, but this 112 is interest for non-leasing source, so transfer over. So this is your gross business income for various sources. So 2016 224. Now the percentage of income over total. The total is 2240, 90 and 10. Now we need this ratio later to apportion your expenses. Okay, alright, now that's it. So that's what you must do here for part A, number 2. Work out how much is the gross. Now see, they want you to work out the tax again. So that's where number 3 come in. Now the part that's tedious now is suddenly examiner say start back with profit. Now if you start with gross, actually it's easier, right? You just take these two figures, you continue. That's what we do in the class. We take the gross, we continue. Okay. Now students who did that in the exam all got the answer penalized. Okay, because examiner says start with profit, so you cannot go on. You go on, your answer is the same at the end one, but you get yourself penalized because you're not following instruction. Okay, now so you have to do again, start from the profit. Okay, number 3, right, tax computation. Okay, so if there's only one profit figure, that means I take this as the leasing business. Okay. So profit before tax is 892. So I gotta do again. No? Whatever you show here, you must do again already, right? So you gotta do one more time. No? So I will have to adjust again the amount accrued. So the 140 and the 73. 140, 73. Adjusting the accrued rentals. Okay, so 140, 73. So 67. Okay, what else you adjust just now is the rental. Now, adjustment for lease number 1, 2, and 4. Okay, 1, 2, and 4. So we minus out 50, 62, 112. So we minus out 224. And then lease number 3, we added in 315. Okay, that's what we did. Now based on that, we will then do the rest of the adjustment of deduction. So from the P&L we see zakat. So add back zakat 10,000, add back depreciation 290. Okay, so after you added back all these, what is left in the account is your expenses, right? So you're left with 600 and 200. Now the 600 and 200 belongs to both leasing and non-leasing. So you started with profit, right? So you must take out the one that is non-leasing, because it doesn't belong to you. So that's why the non-leasing is the 10%. So 10% of the 800 must add back. So we must add back expenses attributable to the non-leasing business. So that is 10% of 800. $80. That's it. So this should be the adjusted income for your leasing source. $1,296. Okay. Now the questions mentioned at the back that CA for the lease asset is 1.2, common asset is 20. Okay, so this is leasing. So the lease asset you definitely can claim. So there's 1.2. Okay, for the business common asset. Now common asset we apportion using your percentage. So which is based on basis of the gross income. So it's 90% of 20, then you get 18. Now in that case your CA absorbed should be 1218. So it's just nice enough. Okay. Right, so statutory income. Okay, so from statutory income, the non-leasing comes in already. That's the other source. Non-leasing business. So how much is the income for non-leasing? Now the gross we calculated just now at the back is 24,000. Okay, minus the general overhead, which is 10% of the 800, so that's 80,000. So 224 minus 80, we get 144. That's your adjusted. Now the non-leasing source, you cannot claim CA on the lease asset. Okay, and no one can claim one because the lessee claim rental deduction, and you don't claim anything. So the CA just disappear in between. Okay. Now, so the CA on the common asset is the 10% of the 20. So you get 2,000 over here. So statutory income is 142. Right, that's it. this is my, like, it should be aggregate business SI, then if you have non-business income you add it in, but you don't have lah, so this is the only thing. So there's the aggregate income then 220. Okay, yeah, 220. Okay, so we minus donation, no? So in this case the donation is zakat, right? So zakat is restricted to maximum 2.5% of your aggregate. So the amount is 5,500. So you restrict to 5,500. So 220 minus 5,500, 214,500. So they only ask for chargeable income. That's it. Okay. So again, your tax com must be in an appendix because they ask for a letter. Alright. Now, the tedious thing is because examiners say start from profit. If you start from gross, it would have been much easier. You straight away take the gross minus the share of expenses minus CA, then you get everything. But here is like you do, then you do again. Okay. So, but he asked that. So follow instruction, please. Okay. Exam, follow instruction. If not, you get your answers penalized. Okay. B, they ask you, what's the rationale of the Court of Appeal's decision that the common expenses must be apportioned to basis of gross income? Now, what was the rationale? Now, just put back the point here. Now, the rationale is because the court interpreted the condition of the law to claim expense deduction. Okay, now that's the section 33, right? Because in section 33 they say that outgoing expenses must be wholly exclusively incurred to produce gross income from the source. So, expenses shall be incurred to produce gross income. That's the logic. So if expenses incurred to produce gross income, then a just and fair basis to share expenses shall be based on gross income as well. Okay, alright, so we look through a few more different examples today lah. Okay, right, we take a break here. We can go for dinner. Alright, come back and resume the class after this.